Testing, can you hear me? Okay. All right, let me do a few things here. Going to share my desktop with you. Hopefully you'll soon start being able to see my desktop. All right. So, just want to quickly talk a little bit about where we are and where we're going. You'll see the course material is under here. I've tried to figure out how to make the collaborate sessions viewable on the left side, and I can't figure out how to do that. Obviously, if you found it, you know how to get there. But here we are in Chapter 3. Chapters 1 and 2 were basically introduction. We haven't covered the math part of Chapter 2 yet, which we're going to do after we get through Chapter 5. That part is going to be on the exam. So I did a drawing that was kind of a 30,000 foot overview. And then we spent a lot of time on the first few slides of Chapter 3 in class. Those things are pretty important. The entire Chapter 3 is important, as well as the drawing that I did, because as you'll see, it is the foundation for the rest of the class. Once we get through that, Chapter 3 is the rules for qualified plans. Then we're going to just drill deeper on that stuff pretty much for almost the rest of this class. Chapter 4, we're going to go into what the rules for pension plans. That'll be the defined benefit, cash balance, money purchase, and target benefit plans. Chapter 5, we're going to, at a high level, go into the rules for profit sharing plans. Chapter 6 is about a couple of different, and we're going to drill even a little bit deeper and talk about the rules for a couple of different types of profit sharing plans, those that are funded with employer securities, stock bonus plans, and employee stock ownership plans. And then we'll also talk about, in that chapter about the taxation of the benefits of non-qualified but stock option plans that you can get through work. Chapter 7, we're going to focus on the rules and taxation when you take money out of qualified plans or when you roll it over into IRAs, things like that. How to do that. That's something that's a critically important chapter. Chapter 8, fairly high-level overview. We'll go through that pretty quickly about the rules for the installation, administration, and termination of qualified plans. It's important to know a few things. There are a few key facts from that chapter, but it's not a lot. Chapter 9 we'll get into, as we call one of the personal tax advantage types of accounts, which is IRAs, and we'll get into the first qualified like plan, which will be SEPs. Then we'll get into the other qualified like plans, Simples. SEPs and Simples are from for small employers, 403Bs, and government 457s are for large government or nonprofit employers, the 457s. That aren't government aren't as qualified like because they aren't in trust. So we're going to get through Chapter 5 before we do the first test after Chapter 5, and then we're going to go back and do the second half of Chapter 2, where we're going to spend some time doing the multi-step annuity problem, so you can answer the question: how much you save? How much does somebody need to save for retirement? Then after the second test is going to take us through Chapter 10, We're going to get into chapters 11 and 12, Social Security. There's a very little bit in there also about Medicare, and we'll get into non-qualified plans. I'd also like to drill down and do a little bit on distributions, not the distribution rules from qualified plans, but how to make your money last. You've got a big bucket of money when you're in retirement. What can you do to make your money last? If we have time, and only if we have time when we get to chapters 13 and 14, and if we get to them, it'll be a very high-level overview. Group benefits are covered a lot in the insurance class, and fringe benefits are you can just touch base on a couple of rules. That's not nearly as important as the rest of the stuff that we're going to talk about. Okay. So chapter 3, I'm not going to spend as much time on the first few slides because we did cover those in depth in class. So I do think it's about the history of what's going on. So the tax preferential treatment of retirement plans, that was kind of a key step. That was very used in a very small way. I think another thing that's overlooked on this slide is when Roosevelt was elected, the New Deal set up the Social Security Administration and Social Security Plan in 1934. That's a big part of the history of retirement in this country and how it's viewed. And then ERISA was a key deal. Again, not going to drill down on these things. The quiz that you're going to have this week in class on Thursday is going to be, I would say, 6 or 7 of the 10 questions are going to be from the slide, the thing that I drew on the board, and slides 4, 5, and 6. Know these slides very well. These are the foundational slides for this chapter. This chapter is the foundational slide for the entire course. It's critically important. So make sure that you know about how plans can be divided, that you can do things like name the defined benefit plans, the pension plans that aren't defined benefit plans. Make sure you know the basic rules for what we mean when we say defined benefit and defined contribution, what we mean when we say pension and profit sharing, and then study some of these rules from 5 and 6, DB versus DC, and pension versus profit sharing. Make sure to study those things. That's going to be fairly big on the test. And then we're going to, in class, we're not going to cover any new material. We're going to do Q&A about this chapter, and we're going to do some application of the stuff from this chapter. So, and then I'll record a lecture on 5 and 6, lecture on chapters 4 and 5 for the next couple of times. Okay, advantages of qualified plans. We talked a little bit about this. You get some income tax deferral. You do get those also in qualified light plans and in personal tax advantage plans like IRAs. You get payroll taxes are voided on employer contributions. This is kind of a key thing. We're not talking about income taxes yet. There's going to be an income tax deduction no matter who puts the money. But when the employer puts money in a profit sharing plan for you, there aren't payroll taxes. You don't have Social Security and Medicare withheld either on the employer side or the employee side. If it's a 401k, a CODA kind of plan, those are not employer contributions, those are employee contributions, and there are payroll taxes that are withheld on those. So that is something that's key. You might think about how you can apply that kind of knowledge, because if you had an employer that, say, could afford to save, you had a client that was a small business owner that could afford to save $20,000, let's say he was the only employee, sole proprietor, he might be able to set up a 401k, he might be able to set up a simple IRA, or he might be able to, let's just say he wanted to save $12,000, so a simple would work, or a SEP. Clearly, the kind of plan that would reduce the payroll taxes would be better. So that would be a SEP plan. A profit sharing plan would also accomplish that, but that would require additional rules and administration and expense. A SEP would accomplish the same thing if you're talking just about one owner who is also the only employee. The main thing that separates qualified plans from all the other kinds of plans is the ERISA protection. And then IRAs and qualified plans have anti-alienation rules. They're even stronger for ERISA qualified plans than they are for IRAs, but generally IRAs also certain annuities, the law is very dependent upon states, do have these anti-alienation rules. Prohibits any action that may cause the plan assets to be assigned, garnished, levied, or subject to bankruptcy proceedings. You'll see in this class, as in just about all classes that have to do with any tax rules or any government regulation, there are always exceptions, and there are frequently exceptions to the exceptions. The exceptions to the anti-alienation rule are in the cases of divorce and if you owe the IRS money. And then protection from employers and employers' creditors is key. The accounts in qualified plans are in trust accounts. Okay, so the advantages of qualified plans. This is kind of a slide that is misnamed. One of the qualified plans, one of the advantages it shares with other tax deferred accounts is that you pay you don't pay taxes on the money until you take it out. That's the tax deferral. Most of the time, the vast majority of the time, with the exception of Roth accounts, and we'll get into that later, but the vast majority of the time, when you take that money out, it is taxed at ordinary income tax rates. Ordinary income tax rates. Here are the exceptions to those. Pre-1974, the importance of that year is because that's when ERISA came into play. There were some retirement plans before that, so but you didn't get the tax deduction, so you get tax treatment on money that went in before 1974. There aren't that many people working now that have retirement plans that predate 1974, so this is not something you see, but you will be tested on it because the CFP board is going to test you on it. Another one of the exceptions, you do need to know all three of these, is the 10-year forward averaging. That's for people who were born before January 1st, 1936, I believe. We'll get into the detail of that later. That you can take a lump sum distribution, and it would be as if you took it out over a 10-year period. Why you wouldn't just roll that over into an IRA, I don't know. Again, that's only for people who are now 78, 79 or older. So not likely to run into this all that often. And again, rolling over into an IRA might even be a better advantage for some of those people, but you're required to know the rules. We'll get into more of this net unrealized appreciation when we get to the subsequent chapter that is, I believe it's chapter 6, that is on the specific types, the stock bonus plans and the employee stock ownership plans. When it's employer securities that are in there, you can get some special tax treatment where you're taxed at capital gains. That's called net unrealized appreciation. and we'll get a lot more into the details of that of those rules later. Okay, qualification requirements. Every plan has a plan document. It's like the Bible of that plan, and it summarizes this is how this plan works. We will get into the rules for eligibility and what must be covered. We are going to talk about vesting. And then we're going to talk about top-heavy plans. Their plans, in order to maintain qualification, cannot just benefit those at the top. If they benefit just those at the top, they're said to be top-heavy. There are also coverage tests to make sure that that the plan is not discriminatory as well. So we're going to talk about those. And then there's special requirements to Code of Plans specific 401k opportunity. And then we are going to talk about limitations on benefits and contributions. Okay, eligibility. This is a rule. You just should know it. 21 and 1 year of service, 1,000 hours worked during the plan year. The employer can always let people in who are younger than that. They can let people in who work less people in with immediately or after 3 months or 6 months. They can always be more generous, but they must consider people who are above 21, above the age of 21, and have worked there for 1,000 hours at least in the last year as eligible for the plan. The plan entrance dates. So how does this work? Once one becomes eligible, you don't go in on the anniversary, typically, of your plan. The plan entrance dates and open enrollment typically happen at certain times, quarterly, or at least every 6 months. If it's 6 months, it'll often be January 1st and July 1st. The rule states that once someone becomes eligible, they have to go into the plan, be able to be part of the plan at the next enrollment date, which cannot exceed 6 months. It's whatever the next enrollment date is, but it cannot exceed 6 months. If you, for some reason, there was a plan that only had one plan entrance date per year, you would have to let people in, even if you had the 21 and 1 year of service. You would have to let people in once they crossed, let's say it was January 1st, once they crossed January 1st, because you can't make people wait more than 6 months. So here's an example. Helium Limited operates a money purchase pension plan. Doesn't matter. It could be any type of qualified plan. The plan entrance dates of January and July 1st of each year. On April 12th, 2014, Bob turned 21, thus qualifying him to be a member of the plan because he had already met the 3 years of service. Unless it otherwise notes, we assume that employees work at least 1,000 hours in a year when you're reading a question like this. On November 14th, Kathy, age 25, celebrated her 1 year anniversary. She had the age, but didn't have the tenure to do it. So Helium then must consider Bob a participant on July 1st, and we'll go ahead and look at the deal because, again, Bob starts on April 12th, 2014. He becomes eligible on April 12th. He becomes eligible on April 12th, 2014. He'd already been working there. He attained the age of 21. The next plan entrance date for Bob is July 1st, and it is not more than 6 months. Had Bob, because Bob's birthday is there in April, had they not had a July 1st entrance date, they would have had to let Bob in before his 21st birthday on January 1st. That is the reason that most plans have at least 2 entrance dates, is the 6-month rule. Let's go back and look at Kathy. On November 15th, 2014, Kathy celebrated her 1-year anniversary. So on Kathy, you can see her 1-year anniversary is then, and then so she must come in on the next plan entrance date, which is January 1st. Okay, here are the rules about coverage. The IRS, this is to make sure that the plan is not being discriminatory. And the IRS, not the IRS, but ERISA, as administered by the Department of Labor, has rules about who has to be covered. So, in determining whether the plan meets coverage, the plan doesn't have to count ineligible employees, and we'll learn a little bit more about who ineligible employees are. And so that would be people who aren't 21, don't work there at least 1,000 hours, stuff like that, or whatever the plan document says if it's more beneficial than that. Employees covered under a collective bargaining agreement can be excluded and don't have to be counted for coverage testing purposes, and non-resident alien employees that do not perform services in the United States. So if there's a U.S. company that has employees in the United States and in another country, you don't have to count the employees in another country. Okay. In order to be non-discriminatory, all plans must pass at least one of the following tests. At least one of the following tests: the General Safe Harbor test, the ratio test, and the average benefits test. That's all, and that is all that defined contribution plans have to pass. Just one. It's either A or B or C. If you're taking notes on this, go ahead and write or and or between the General Safe Harbor and the ratio, and or between the ratio percentage and the average benefits test. In addition, defined benefit plans must pass the 50-40 test. So go ahead and put an and there, but it's only for DB plans, so cash balance and defined benefit plans. Defined contribution, fine, must pass any one of these three. Often you will see questions written in a way such that says, which of the coverage tests, if any, does this company pass? Well, if you do that, you should do the Safe Harbor test first, because if they pass the General Safe Harbor test, that just means 70% of, that's at least 70% of the non-highly compensated employees are covered. We'll get into defining what highly compensated means in a minute. So for coverage, they look at compensation. Remember that, C and C. Coverage looks at compensation. So of the non-highly compensated, at least 70% have to cover if you want to pass the General Safe Harbor test. If you pass the General Safe Harbor test, you automatically pass the ratio percentage test. Because if you, let's say you have 10 non-highly compensated employees and 5 highly compensated employees, if 8 of the non-highly comps are covered, that's 80%. Therefore, the ratio percentage test, the percentage of non-highly comps covered, is 80% over the maximum number of highly comps that can cover would be 100%, which is it would be 100, and then you'd have 80 over 100, which also equals 80%. So the ratio percentage test, that number is always equal to or higher than the general safe harbor test. Is always equal to or higher. Doesn't matter, you just have to pass one of them. If you don't pass the general safe harbor test, meaning you don't cover 70% of the non-highly comps, that means that if you want to pass the ratio percentage test, you have to exclude a highly compensated person in order to have a chance. The average benefits test, and we are going to do, when we get in class, we are going to do some examples of this. The average benefits test looks at the average benefits percentage of the non-highly comps over the average benefits of the highly highly comps. So that is a little bit different. That is a little bit more difficult to pass in the real world. Mechanically, it's just another ratio test that looks at benefits of the non-highly comps to the comps. It must equal 70%. All of these are 70 is the bar. So we're talking about high compensation. The highly comp equals anybody for owner employees, anybody that owns at least greater than 5%, not equal to 5%, but greater than 5%. Anybody that owns greater than 5% is considered highly compensated, even if their salary. If you own less than 5%, 5% or less, then it's compensation of $115,000. So if you own 4% of the business, compensation above $115,000 includes you. Compensation for non-owner employees, it is compensation in excess of $115,000 this year. So basically, it's 5%. If you own greater than 5%, you're considered, and no matter what, if you make $115,000, you're considered highly compensated. The other piece of it is there is an option that can be chosen, and we will do an example of this later, that is in the top 20% of salary ranked by employees. So you can't get out of it for ownership if you're in the top 20% of salary, but you can get out of it. If you make $200,000 and you're not in the top 20% of employees for compensation and you don't own any part of the company, then you might not be considered a highly compensated employee, but the company must elect to have you not considered a highly compensated employee. Okay, so there's known as attribution rules. So if I own part of the company, if I own greater than 5% of the company, but my wife does not, but we are both employees, she would still be considered highly compensated because my shares would be attributed to her. Also, if I have my parents and my children or grandchildren in the business. No, not siblings. It is children and grandchildren, 2 generations directly down, 2 generations directly up, and the same generation within my household. If I am married to that person, my shares will be attributed to them and they will be considered highly compensated. The 50-40 test. Again, this is only defined benefit plans. So what does this mean? The 50-40 test is you have to cover at least 50 employees or 40%, whichever is less. Whichever is less. 50 employees or 40%. So, because you can't have a fraction of a person, if there's one employee in the company, that employee must be covered. You wouldn't have a plan if nobody were covered, but understanding this is pretty much a test question right here. You should star this. If you have 2 employees, if you have 2, 3, or 4 employees, you must cover at least 2. Actually, if you have 2 employees, you can cover just 1. 1 or 2 employees, you can cover just 1. If you have 3 or 4 employees, greater than 2, 3 or 4 employees, you must cover at least 2. 40% applied to 2 is applied to 3 employees is 1.2. You must round up. 40% applied to 4 employees is 1.6. You must round up. If you have 5 employees, you got to do 40%. You have to cover at least 2. Up to 125. Why do we say 125? Because then anything less than 125, really, we just look at the 40% rule. At 125, 40% of 125 is 50. Once you get above 125 employees, 126 or a million employees, you pass this portion of the cover test, you pass the 50-40 test if your DB plan covers at least 50 people. Vesting. Vesting is defined as how ownership interest in the plan benefit accrues to the employee. I added in the plan benefit because we're talking about the qualified plans here. You may always be more beneficial than the maximum vesting schedule, but you may not be less. Here come for a defined contribution plan. You can use if you use the standard 21-and-1 eligibility election, you can use the 2. Hardly anybody ever uses the 2-year eligibility election. If you use the 21-and-1 year eligibility election, you can choose a 2 to 6 year graded vesting schedule or a 3-year cliff. A 2 to 6 year graded vesting schedule or a 3-year cliff. What does that? Why do we say a cliff? Because until you get to your 3rd anniversary of employment, you are not eligible. You don't get to take anything. Once you reach your third year of employment and eligibility, then you get to take 100% after that. It's a cliff that goes away. The 2 to 6 year graded vesting schedule works like this. After your 2nd anniversary, you become 20% vested. After your 3rd, 20% more, so 40%. After your 4th, 60%. After your 5th, 80%. After year 6, 100% of employer contribute. You're vested in 100% of employer contributions. This means that if somebody leaves employment, and let's say there's a profit sharing plan, and there's $200,000 in your account, and you've been there 6 years or greater than a 2 to 6 year graded vesting schedule, you get to take all of it. But let's say 100,000 because that's easier math. But if you leave after 4 years and some fraction, anything less than 5, then there's $100,000. You only get to take $60,000 of that. The rest is considered a planned forfeiture. So the math problems, you're more likely to see problems about 2 to 6 year graded vesting schedules than the 3-year cliff. Okay. By the way, all cash balance plans pretty much use a 3-year cliff graded, even though that's a defined benefit plan, use a 3-year graded 3-year cliff vesting schedule. When we talk about defined benefit plan vesting schedules, we're talking about DBDB plans. The cash balance plan, and I'll go ahead, you can make a note of it right here on this slide. The cash balance plan has a rule that says 100% of cash balance plans must be vested after 3 years. So they normally don't do any grading. They normally go the strictest that they must go, which is a 3-year. The reason that hardly any firms do the 2-year eligibility election, you would only do this if you had a very high turnover within 2 years, but not 1. Maybe if you were working in if you ran a business in a college town or something like that. 2-year eligibility election, it basically becomes a 2-year cliff. It becomes a 2-year cliff. After 2 years, you're 100% vested, so that's why hardly any firms choose that. Employee contributions, regardless of the type of plan that we're talking about, really, most of the time we're talking about 401ks, but all of that money is always yours. When we talk about vesting, it is for employer contributions. In defined benefit plans, they are allowed to have a 5-year cliff and a 3 to 7 year graded vesting schedule, assuming that they are not top heavy. Assuming that they are not top heavy. Otherwise, they're and they have the same 2-year eligibility election as if you elect the 2 years, it's a 2-year cliff. The top heavy plans revert to the same thing that employer contribution, the same thing that DC plans, 2 to 6 year and 3-year cliff. So non-top heavy plans, 3 to 7 and a 5-year cliff. Top heavy plans, 2 to 6 and a 3-year cliff. You have to know this. This is basic stuff you need to understand, and we're going to do some application of this in class. So here's an example. Craig has attained 3 years of service with the Stone Corporation. Over those 3 years, Craig has received employer contributions to a qualified profit sharing plan in the amount of $60,000. So we look at the 2 to 6 year graded cliff. We say 3 years equals 40%. We multiply the 40% by the $60,000. If he leaves before his next anniversary, he will only be able to take $24,000 with him. Could have asked what is his vested amount? We could have asked what would be his planned forfeiture. That would be the remainder amount, which would be $36,000. Mallory has attained 4 years of service with Pharmex Corporation, sponsors a defined benefit plan that is not top heavy. When they tell you that, you must know DB, not top heavy, 3 to 7 year cliff, a 3 to 7 year graded vesting schedule, or a 5-year cliff. You know that that's what it has to be and does not permit employee contributions. That also means that all of the money, if it doesn't permit employee contributions, that all of the money follows the vesting schedule. Mallory has an accrued benefit to date under the plan of $30 per month at retirement. If the plan follows a 3 to 7, or the question might just say the least generous graduated vesting schedule or graded vesting schedule, and Mallory terminated her employment today, she would be entitled to 4 years is 40%, 3 years 20, 4 years 40%. So we multiply that. She would be entitled to a benefit of $12 per month at her retirement. So, special plan requirements for top-heavy plans. A DB plan that is considered top-heavy, so they look at not plan assets, but they look at the present value of the accrued benefits of key employees, not highly compensated, but key employees. And we'll compare what the rule for who is highly compensated versus who is key in a little bit. Exceeds 60% of the present value of the total accrued benefits of the defined benefit plans for all employees. So this is a different rule. This is not a 70% test. This is different. The 70% tests were for coverage, not for top heavy. So in a DB plan, if the highly comps have 60% of all plan, the present value of all plan benefits. Defined contribution exceeds 60% of all plan assets. It's considered top heavy. So key is 60, coverage is 70. Key is top heavy. Key employee is top heavy. K-E-I-T-H. Key, K-E, key employee is I, top heavy. Keith. Key employee is top heavy. That's how I remembered that. You can write that. Key employee uses the top heavy. Top heavy is 60. Keith, 60. Coverage, 70. Remember that. A key employee is someone that's a greater than 5% owner, similar to what we have for coverage for highly compensated, or a greater than 1% owner with compensation in excess of $150,000. That amount doesn't go up. A few years ago, the coverage test wasn't 115, it was 100, but that number is going to probably keep going up each year or every couple of years. Or an officer with compensation in excess of $170,000. Last year it was $165,000 or $160,000. That number is going to keep going up regardless of any ownership. So we've got 5% regardless of compensation, 1% and $150,000, or an officer with compensation in excess of $170,000. So let's apply this a little bit. Somebody who's not an officer can make $1 million and not be considered a key employee, but would be considered top heavy, because that person is not, as long as they don't have any ownership in the company, or they own less than 1% of the company. Special requirements for top heavy plans in a DB, it's 2 to 6 year graded, 3-year cliff. This did not have any impact on, so this was as a result of the Pension Protection Act of 2006. So that really only affected DB plans. So being top heavy is not all that big of a deal for DC plans. It is a big deal potentially for DB plans, and we'll see what the effect is of being top heavy for DB plans in just a minute. So when a DC plan is top heavy, the non-key employees, again, key employees, we're focused on key employees for top heavy, must have a contribution of at least 3%, except if the key employee's contribution is less than 3%, then they can match it. But it must be at least 3%. So you'll often see this as a safe harbor rule, and we'll get into for top-heavy 401k plans, and we'll get into this in a little bit. Special plan requirements for defined benefit plans. This is another test problem. I won't quiz you on this, but this is another test problem. The employer must provide a non-key employees with a benefit of at least 2% per year of service, up to 20% times the employee's average annual compensation. This only affects those plans that have a funding benefit that is less than 2% per year of service. So, you can tell that this textbook manufacturer is from Louisiana because they talk about Boudreaux, Cadeau, and Thibodeau corporations. They sponsor a DB plans providing benefits based on years of service and employees' average annual salary. That's what almost every DB plan does. Boudreaux, Cadeau, and Thibodeau provide benefits of 1%, 1.5%, and 3% respectively for each year of service. I've never seen a plan provide 3%. I've heard of 2.5%. So, Thibodeau Corporation, even if their plan is top-heavy, their plan is not going to be affected by being top-heavy because they provide at least 2% per year of service. But if their basic funding formula is less than 2%, like Boudreaux's and Cadeau's plan is, then we are going to have to make, and the DB plan is top heavy, then we're going to have to give non-key employees extra money for the first 10 years. Then we might not have to give them anything for some while after that, and we'll see. So if you look here, let's look at Cadeau. Let's look at Boudreaux. We're looking at a total of 15 years of compensation here. So for Boudreaux Corporation, we will look at the left columns, column A and column D. For Boudreaux Corporation, if Boudreaux has a top-heavy DB plan, key employees get 1% for 1 year. His funding is 1% per year of service, and so 2% for so they get 2% at 2 years, 3% at 3 years. They got to have 4% at 4 years, all the way out 15 years. Let's say we could even go out to 20. They would be at 20%. The minimum funding requirement for Boudreaux's plan, they would have to go 2% for non-key employees until you get to year 10. And then at year 10, they wouldn't have to provide any additional benefit basically from years 10 to year 20. After year 20, then Boudreaux Corporation's key employees would have caught up with their non-key employees, and then they would move in lockstep. We can see this example a little bit more clearly when we look at Cadeau's corporation. Cadeau, comparing columns B and D, key employees, again only if it were top-heavy, would get 1.5% per year of service. Non-key employees would get 2% per year of service until they get up to 20%. So after 10 years, you would see that the non-keys would have 20. The keys would have 1.5 times 10 years, or 15%. And then after the 10th year, basically, the non-key employee, the non-key employees would be frozen until we get out to year 14. They would be frozen at 20% until we get to year 14. because as the non-keys caught up. So then the non-keys, when they would go to 21% in year 14, the keys go to 21% in year 14, the non-keys would go to 21%. We'll do example of that in class as an exercise as well. Okay, for the only DC plans that are affected for being top heavy are really the CODA plans. So we'll talk about the actual deferral percentage and actual contribution percentage tests, and we'll discuss that in Chapter 5. Okay, the plan limits on benefits and contributions. In a defined compensation plan, they should call that a limited compensation plan, because what is limited, the amount that can be considered for compensation is $260,000 for 2014. For defined benefit plans, it is the benefit that is limited. The amount that can be considered, the maximum benefit in 2014 is $210,000, or 100% of the average of the employee's 3 highest years of consecutive compensation, not considering more than $260,000. We can't consider that more than that, and we can't pay anybody more in retirement from a DB plan than their average of their 3 highest years of compensation. And the payout cannot exceed $210,000. These are very key facts here on slide 29. So in DC plans, the maximum contribution is 100% of employees' compensation up to, this is employer contribution, up to $52,000 in 2014. You'll note the relationship that exists. $52,000 is 20% of $260,000. You'll also note that the maximum contribution for aggregate covered compensation is 25%. So the limit consists of employer contributions, employee contributions, but not catch-up, but does include any forfeitures that are allocated to the participant's account, and does not include the catch-up contributions. So profit sharing and 401k, you can add the catch-up contributions if an employee is 50 or older to that. So the catch-up contributions, believe, are $4,500. I think you can do $56,500 for somebody if they have a 401k. That's only for the CODA. Catch-up is only for the CODA. Okay. In employers that have multiple plans, the maximum deductible amount, which means the maximum the employer is realistically going to put in there, is 25% of the employer's covered compensation, or the required minimum funding of the defined benefit plan. So in this case, if you're an advisor to an employer and a plan sponsor, and their goal is to sock away the most money that they can, and let's say you have a DB plan in place for them already, if they are already putting away 25% of covered compensation or more in the DB plan, doing a DC plan doesn't make any sense, because they're not allowed to put anything in there, with one caveat, and we'll see that in a little bit. And here's what the certain cases are. If no employees benefit under both plans, that would be a particular case. If the DB plan is subject to PBGC, well, defined benefit plans are subject to PBGC, but in this case, what they mean is if the plan is behind, or the defined benefit plan is underfunded, they're not going to, and is trying to catch up, they're not going to penalize the employer for making those extra contributions to catch up. If a plan is a multi-employer plan, then this rule is ignored. So if there's one person that owns multiple companies, that would be an example. Or if, for example, somebody uses ADP or Paychecks and they use their retirement plan that they use not only them for payroll but for their employee benefits, then that would not be considered. And again, the salary deferrals are not considered, so 401k contributions are not considered. And if contributions to the DC plan do not exceed 6% of compensation. So really, when I was on this slide and I said, if the DB plan is greater than 20%, as long as you don't put in greater than 6% of compensation in the DC plan, then you're okay. If the DB is over 25% or more, or actually 19% or more. So let's say it's at 20%, you can still put in 6%. That would be 26, but here the aggregate, they say the max is 25. But as long as the DC is 6% or less, you're okay. Okay, here's some examples. Hopefully the examples will drive that home. Lori's Law Practice operates a defined benefit plan and a DC plan for their 12 employees. The annual covered compensation for Lori's Law Practice is $1 million. The actuaries determined that the contribution of $120,000. That's who says, okay, this is how much you have to fund. The present value of the liability that was accrued that year is $120,000. That's 12%. That's 12%. In this case, Lori can make a tax-deductible profit-sharing contribution on behalf of the employees up to 13% or $130,000, again, of covered compensation, so that the aggregate doesn't exceed 25. Let's look at another example. If, however, the actuary had determined that Lori needed to make a $400,000 contribution to meet the accrued liability in that defined benefit plan, Lori could only make a 6% contribution to the profit sharing plan. Now, realistically, that's not an insignificant number if you're considering someone that makes $260,000 and you want to make a contribution for them. You do 6% times $260,000. That's $15,600, and then if they have a 401k, they can do an additional $17,500, and they can do a catch-up. Actually, I said $4,500 earlier. I misspoke. They can do a catch-up of $5,500, which takes you to $23,000, on top of the $15,600, which is on top of the defined benefit plan. So 6% is not chump change. Okay, control groups. So here's a rule. This rule came about because employers got tricky and said, hey, I'm going to own 2 different companies, and I'm going to have certain employees work for one company, and I'm going to have the employees that I really want to take care of work for another company, and Department of Labor said, that's not how it's going to go. So control groups consist of 2 or more commonly owned operations, and they're intended to prevent potential abuses, not by taxpayers, but taxpayers for sure, but by the business owners. So the parent and subsidiary control groups or brother-sister groups, doesn't matter how it is, it's common ownership. So control groups are treated together for testing and for coverage limits. And there you go. That is the end of this chapter. This was pretty deep. The rules that I covered after the first few slides are important rules. I'm going to quiz you. 3 or 4 questions are going to be on that. Make sure to study, hit hard, slides 4, 5, and 6, and your notes from what I lectured on in class. I will see you on Thursday night at 7 o'clock.